Well, good morning to everyone who's on for today's presentation. This presentation will just be me, Margie, flying solo. Liz is with her mom, who is recovering from surgery. And as much as we'd all like to have Liz on board for today, that takes priority. So best wishes being sent for Barbara's speedy recovery. So speaking of recovery, as you will see here today, the presentation is called The Trail to Recovery. And this is compiled from research from our LPL Research Department, as we are now a little further than the mid-year point. And we're going to just tie in throughout this, this analogy of a trail. And as you look at the backdrop here, you've got the two individuals, and they've pulled out their trail guide. I imagine that they'll be looking for trail markers, which is what we always do in this capacity in terms of the assets that you have allowed us to manage on your behalf. We're looking for those indicators. We pull in the deep resources, not only of LPL, but of many different institutions to help us make decisions moving forward. So when we think about those trail guides, we think about a couple different things. And those are certainly, number one, the economy. And we're going to dive deep into what's been taking place in the economy in this. And yes, we've heard that this term multiple times this year. We'll continue to hear it, but it really has been an unprecedented year. So we'll look at the economy, we'll look at some charts throughout, and then we'll take a deeper dive into stocks and what we're looking at and our thoughts and forecasts going forward. We'll pause on bonds for a bit. So we've got our stocks, we've got our bonds, and then I'll round out today with some discussion about the upcoming election, which is now, of course, just less than 3 months away. So as I mentioned, this unprecedented era that we've been through, I'm well into 3+ decades in this industry. Many of you on the call today have weathered the storms with Blue Heron by your side through recessions in the past. And here we are again. And it's always our job on working on your behalf to help you navigate. So thank you for the trust that you put out to the entire Blue Heron team. So as I said, we're gonna take this big broad view of the economy first, and think back to early 2020, and what was not a household word was COVID or coronavirus. And I think back to those early months of the year, and February, perhaps it was hitting your radar screen that something was going on over in China, and maybe COVID was starting to creep into the news to some extent. But there weren't too many thinking that it would, number one, fall on our shores, and number two, become a worldwide pandemic to the likes of which we have not seen for 100+ years. So that's where we are in 2020. We have gone through now the quickest recession ever. And we'll look at that chart in just a minute. So we've got this time frame, I will say it throughout, it is unprecedented. But thinking back to the extended economic growth cycle that we had been going through, and you heard Liz and I both saying it numerous times, we were not sure what would disrupt what I refer to as the party, but we knew there would be some disruptors at some point. So here we are in the midst again of COVID world as we know it today. So it's just uncanny in terms of the contraction that we have gone through. And you can see that on this chart showing gross domestic product, which is the measurement of all goods and services produced, going back to the early 2018 timeframe. And you'll see that we were hovering in that 2% give or take. The economy is moving along. You know, you can't move an elephant at a very quick pace, but what started to happen in that first quarter, and then what happened in the second quarter, we saw these contractions in our economy. So starting to move into negative contraction territory in the first quarter. This presentation chart goes back to June 30th. So just from June 30th to present, we know what this contraction is now, what that number. So it wasn't as bad as a negative 34.5, but it sure was bad. The number came out at 32.9, I believe. So this is severe. And just to give you some context as far as the severity of this contraction, and many of you have been working with us for a long time, thankfully, wonderfully, and we thank you for that trust again. But think back to that 08-09 time frame. That contraction was a little shy of 8.5%. So this is huge. Our economy seized up, but it was self-induced. Remember what was taking place. We were told to close the doors. We were told to go home, and whomever could work remotely could continue to work, but we had an economic shutdown. So thinking about where we are today, here on August 6th, and we have already experienced a tremendous snapback. So as often is the case, the numbers aren't really relayed out to us until well after the fact. But the projections on this snapback for the third quarter, in which that we are in right now, is a 20% uptick. So this has been the quickest downturn, and it looks like the fastest recovery in history. This goes back, and these are numbers just not even evidenced in the Great Depression. So if it felt like a roller coaster, I think it was the Superman roller coaster, where it's just such a significant drop. But thankfully, we have seen some surge ahead. With regards to forecasts, and I mentioned again, there's a multitude of indicators that we look at. So the chart that you're looking at right now is looking at a couple different cases, but I'd like to focus on the base case here. And when we think about the U.S., which is where the vast majority of our equity and bond allocations have been. So international versus U.S., our international participation has been minimal for several years now. And that has been contrary to some other advisors' calls, but it has worked out very well for us. Now, does that mean that there may be some opportunity in international going forward? We believe that that may start to show itself, but for right now, we are very content to stay, for the most part, in the U.S. with stock and bond allocations. So back to our base case here. We expect when we look back at 2020 that we will see that this contraction would be somewhere in this negative 3 to 5%, which is a huge rebound from the depths of which we saw in that first quarter. I mentioned international. The second line here, developed ex-US, think in terms of Western Europe. Their economies are struggling to come back. Now, whether that's due to their monetary policies, I was listening to Bloomberg this morning on the way in. They've got some struggles going on there, right, wrong, or indifferent. They're in negative interest rate territory, which is not where our Fed is intending to go. So international, we're participating, but we do think that they will continue to lag in economic recovery. Emerging markets is an interesting story right now, and that's primarily because we have a weaker dollar. This is not a market for everyone because it tends to be that much more volatile. So we have some light positioning in some growthier allocations, but once again, we will err to the side of caution. And if emerging markets continues to show us some steadfast growth and looks a little bit more dependable, then perhaps we'll be adding that. At the end of the day, we are expecting 2020 to continue to have economic growth as COVID cases decline, and as that eventual vaccination not only is discovered, but as we look further into 2021 and into 2022, that there's widespread distribution of said vaccination. Continuing along with our trail, and kudos to the marketing department for coming up with some graphics here. The bull and the bear are at odds, as you can see on the canoe, and the bear may be looking at this river that perhaps was rather tranquil. And as we think in terms of what has been taking place over the last couple of months, we've had a nice steady climb. We really have not had much volatility. And I've had many clients say, well, yeah, once again, the market's up. And there are reasons for it, but those reasons are because of the forward-looking mechanism that the stock market is. So are we at some crosshairs here? Perhaps we are. The market has come so far, so fast, that perhaps it's time for some pause. In the different allocations that we have in place, we have been making some modifications through the summer and taking some risk off the table as we start to make our way closer to the election time frame. And again, just because the market has come so far, so fast. Let's look at bear markets just for some historic clue as to what has taken place in the past, and then how things may shape up going forward, or will this year be a bit more of an anomaly? When we look at these recessions in the past, you can see some outliers where the duration of the bear market may have been just a few months, but that only was that one time back in July of '90, in which case it took just a few months, 4 months, for recovery. Back in the early '80s, it was a longer extended bear market, but it did recover pretty quickly. And where we are today, right now, this bear market may be the quickest, and the recession may be the quickest ever. Again, until the textbooks write it and the Bureau of Statistics gives us those numbers, but when it felt like it was such a jolt, it really truly was. So this 34% decline in just this short period is, once again, as I mentioned, unprecedented. And the strength that we've seen, the resiliency that we've seen in many, but not all, And that's very important here. As we test the highs, which is where we are, testing the highs of the S&P 500 right now. So earnings drive the stock market. At the end of the day, the stock market is comprised of ownership of corporate America. And whether that company is doing well or not doing well is determined by how their earnings are. So looking again at recessions in the past to see where do we fall in line with the averages, we're right there. The decline that we experienced is roughly 25%. Those earnings have got chopped short by that 25% give or take, which is falling well in line with the average going back to 1945. But what has transpired over the last couple of months is really uncanny. You may have caught over this last week or so that some of the big tech giants are reporting extremely strong earnings. And in addition, the forward guidance has been ramping up as well. So if we can continue to have lower unemployment claims and more people are put back to work, that cash that's been sitting on the sidelines that has been building up, whether that is through the Fed stimulus or whether that's through just not spending, as that starts to make its way back into the system in our consumer-driven economy, the expectation looking further out is that this market can resume. But over the near term, we think that we're pretty well in line and have even gotten a little ahead of ourselves. Once again, you're looking at a chart presented through various indicators, and I once again want to focus on the base case. So not too hot, not too cold, just looking at the S&P 500 and where for right now the expectation is that we may end the year. Well, that 3,300 number is where we are today. So we've already hit it. Now, we're not changing things up for right now, but if we continue to move over these next months, economies continuing to experience growth, we have more positive news on vaccination, maybe we will be hitting these numbers of the bull case. That 3450 on the S&P is only 4% higher than where we are today, whereas the bear case is roughly 20% lower. So we want to pay heed to what could disrupt. We by no means are wearing rose-colored glasses. We always at Blue Heron need to be mindful that some disruptor could come along, and then what? And based on how many years till retirement, how many years in retirement, where that risk tolerance is, all of that is helping us to determine the management of your assets. So this bear case, we certainly hope that this doesn't happen, but if it does, we have already made an allowance that we will wade through an extended negative market. Earnings per shares, as I mentioned before, are the drivers of the valuations of the stock market. And for right now, we do think that things have gotten a bit ahead of themselves. As earnings expectations continue to move positively, then it makes that valuation a more acceptable number. And then the last line here is looking at bonds. And we're going to segue into bonds in just a minute, but in terms of forecasting with expectations for yield, just for comparison, right now, the 10-year Treasury yield is a mere 0.56, unless it's changed in the last day. That's where it's been. So this is showing us that even though Jerome Powell of the Fed is indicating no moves for them, that does not mean that we can't see yields tick up a little bit. The bond market can start showing higher yields. So as I mentioned, we'll segue over here into the bond market. And let's take a look and see how our hiker's doing now. Well, somewhere along the way, he picked up a backpack, maybe a tent, maybe some foul weather gear. He's got his walking sticks and he's got his dog. Well, I'm going to tie that into the bond market. So bonds, as just witnessed, we're not looking for a big coupon. We're not looking for them to provide us a whole lot in the way of return or dividend yield. In fact, in many cases, stocks have higher yields. So if we can get appreciation potential and yield that's higher, we still favor stocks over bonds. However, depending on where one is in retirement, has a need for some additional stability, just to avoid some sleepless nights, and this helps us to determine just how much we want to have in bonds. So we've leaned a little bit more in this direction as of late, just to put a bit more stability into portfolios. So we're not looking for a great deal of yield, but what we are looking for is something that's not going to be moving to the extent that stocks could in the near term. So many on the call might remember this period going back to the mid-'80s, and I'll have to fess up that this was the start of my career. So I do remember interest rates at these double-digit levels, and whether it was, back in the day, there were actually coupon bonds that people would come into the office and clip those coupons. Well, those days have, okay, they are long gone, but coming back to where interest rates have been and where they are today, they've been declining for years and decades. So yes, CDs were higher, but guess what else was high? Inflation, loans, buying a house, mortgages, car loans. They were up in this teens level, and who would have ever thought that we'd be looking at 30-year mortgages in the 3% range? I mean, this is just uncanny. So, and we've seen it with clients who have gone through refinances, who have been thinking, did they want to have a second home, vacation home, and maybe the impetus to just make that decision has been just how low rates have come. Now, the flip side of that is the fact that if we were too heavily invested in what this perceived sector area is, well, we don't have something to combat inflation. And I'll talk a little bit more about inflation in just a minute. Expectations going forward. This is a survey result of economists, and as mentioned earlier, the Fed has been very vocal that they are not planning on any interest rates, not only through the end of this year, not only through 2021, but have indicated that they don't expect to raise rates until even 2022. So economists are on board with this. By the time we're in 2023, certainly a higher level of expectation that we will see rate hikes. The Fed has other tools at its disposal. QE, quantitative easing, building up their balance sheet, is happening right now. So it's come up a few times in terms of whether the US will go into negative interest rate territory, and there has been a very strong response of no. All right, so now we turn the table to the upcoming election. And it could very well be, as we move through these next few months, maybe even election news will overtake COVID news. You know, in the next week or within the next couple of weeks, the vice presidential nominee will be announced. But before that, let's take a step back and think about what has taken place this year as we lead into this upcoming election. We've got a pandemic that we haven't seen in over 100 years. We've got a recession, a very deep recession that, yes, it looks like we're emerging from, and maybe the quickest recession ever, but a recession nonetheless. We've got heightened partisanship, sorry about that, and we've got racial tension. We've got so much going on, and the two candidates. We've got one, I think we can agree, an unpredictable president, and we've got a candidate who is the oldest ever. So while right now I think in the polls Biden is ahead, we've got these months leading up to it. I'm going to bring up a couple charts in just a minute, and I think it's just anyone's guess right now. We get that question from you all often, especially in election timeframes, like, well, how does the market respond based on whether we have a Democrat or a Republican president? And before we go there, we want to take a step back and look at it from a Congress standpoint. And so, yes, one is, of course, part of this equation is the president, but the other very important component is what is the House and what does the Senate look like? So the chart that you're looking at here is showing us that actually a split Congress, where we've got checks and balances in place, is most beneficial to the stock market. It's also across all fronts, and this is something I think, again, is very important to note, across all fronts, that we do have an expanding economy. The economy does continue to grow. So even if that's not the case this year, that continued growth is occurring here. If it's a Republican-led Congress, stocks do better. If it's a Democratic Congress, the economy and GDP does better. But at the end of the day, this split has actually been most beneficial. What is a really interesting indicator as far as who may eventually win this 2020 election is just how well the stock market is or is not doing. And what you're looking at here, going back for, 70 years, back to 1950, that if the 3 months leading up to the election are favorable, then it's an incumbent party win. On the other hand, the stock market going back through this time has almost been spot on, indicating if the stock market is negative, that the incumbent party loses. So again, all eyes and ears to the market as we move forward. And again, from our standpoint in managing your assets through this period, the market has provided tremendous returns. Thankfully, we have experienced those with your assets. There was a statistic I read this morning, and while I've seen this before, it just, again, I think it bears sharing, and that is that in the midst of that March-April downturn, it was to the tune of about 18% of investors who jumped out. Now, again, that's an emotional decision, and the other part of that decision is going to be when to get back in. But let's just even isolate that. For that 18% that jumped out, and it's even higher with regards to the older the individual gets, whether in retirement or not, it's even a higher statistic. But if they're sitting there now in cash that may feel safe, number one, it's not keeping up with inflation. Number two, they're not getting paid anything. Number three, they did not experience this upturn and they locked in their losses, something that you will not see Blue Heron make that kind of bet, ever. Now, we might lighten up on stocks, as mentioned. We also want to look for opportunity always, and we will sway those depending on what our research is showing us, certainly through LPL Research, and we do rely heavily. And when we think about the upcoming election and taxes and the changes that, depending on who's elected, that too weighs into our strategies and on it goes. So today is a pretty short presentation, but number one, we just wanted to remind you, we're here. We are working kind of half and half, remotely and in the office. As always, you can reach out to us if you have questions. Thank you for the questions that some sent ahead. Hopefully I touched on those through the presentation. Because we are recording, we are not able to have an open chat, but please feel free to email questions through Debbie. She makes sure that those get sent out to the team and that we want to be as responsive as you would expect that we should be. We, again, thank you, as always, for the trust that you put into Blue Heron, into helping you to be a good steward of your blessings. And we wish you good health and continued safety going through the rest of this year. And we look forward to seeing you maybe on Zoom for a while, but we look forward to seeing your faces. So take care. We'll talk with you soon.